Alrighty. So this is the first DeFi University technical analysis wrap. And what I want to run through are, just the most important charts of the day. So I'm going to go ahead and waste no time. I'm going to hop in and let's see here. Let me just make sure that everything is working. It looks like everything's working except for Arena. So I'll go in and I'll fix Arena probably tomorrow. But I hope that the live stream is working for everyone else here. Let me just go ahead and hop into YouTube Studio and just make sure that this is actually working here. I think that it probably is. There we go. It says it's live. Awesome. So I'm going to go ahead and hop right in and let's take a look at the most important charts of the day. Let me go ahead and share my screen here, and we're going to roll right into TradingView. And so let's see. I think I should have the screen share rocking and rolling. Let me just go ahead and there we go. Awesome. Let's hop into TradingView. All right. So there are a couple of things that I want to take a look at first. The first item that I want to take a look at is just Bitcoin. Why don't we go ahead and start with digital assets? All right. So the most important thing for me here with BTC is that we've got a longer term uptrend. So I've zoomed out here to a weekly. Let me go ahead and remove these drawn objects so that we can just see what we see. This is actually a monthly. Let's zoom into a weekly. Now, this is clearly an uptrend. Even with the 36% correction that Bitcoin has suffered over the last couple of months, even with that correction, we're still clearly in a well-defined uptrend. And so what is the definition of an uptrend? Well, it's simply a series of higher lows and higher highs. And so that is clearly what we see here on BTC on the longer term time frame. Zoomed out to a weekly, taking a look at the last, 2.5 years or so. But within that longer term uptrend, we see a pretty clearly defined bear flag pattern. So I can just go ahead and write that here. You see, here's the pole and here's the flag. So this is a bearish continuation pattern, and it looks like we're about to see the next leg lower out of BTC. So let's go ahead and see what would invalidate that hypothesis. Where would we know we're wrong? If we think Bitcoin's going to move lower from here, where and how would we know that we're wrong? So I just want to start by throwing down a horizontal at what I think is an important level of resistance right here. This level 94.8, 94.7, something like this. This looks like some important resistance. And the reason why I think it's important resistance is because we got this little false breakout over, a couple of days ago. So this push higher and rejection, that makes this a false breakout. And so I think that this is probably an important level of what is now resistance again for BTC, right around 94.7. So now that we've got this rejection and that false breakout, why don't we go ahead and draw in a trend line for support? We're going to use this level. That's the local low from, what was that? The end of November in BTC, around 80K. We're going to use that as our anchor, and then we're going to connect to the next higher low and extend to the right. That gives us our trend line. So here is trend line support, and here is horizontal resistance with that false breakout. Now, it looks as though Bitcoin could be moving back down towards support to test support. So how would we know that we're wrong? If our bias is to the downside, if we think that maybe BTC could break down from here, well, if we're wrong, we would expect there to be a bounce at support. So if there's a bounce at support, then we would need to get back above not just 94.8, but also make a high above this local high there at 97 and change. So if I just go ahead and grab an arrow tool and mark that real quick, this local high here, this is the next level of resistance if that level at 94.8 breaks to the upside. So for right now, my bias is lower because the longer term trend here is lower. And this is a pretty well-defined bear flag pattern, and we got a pretty good false breakout here. This looks like a relief rally. That's what it looks like to me. Now, also, If we zoom back out from a daily to a weekly, there's one other item that I want to point out here, and that's simply about Bitcoin's cycle analysis. And so if we were on the weekly, I want to go ahead and remove the 200 week, and instead I want to go ahead and throw down that 50 week moving average there. And what I see on the 50 week is not only has it been broken, but we've got two weekly closes below it. And so in previous Bitcoin bear markets, two weekly closes below the 50-week moving average, that has marked the start of a bear. So the fact that we were able to get a nice little relief rally up to the underside of the 50-week and then we're rejected, that tells me that the likely direction for Bitcoin is probably lower in the immediate term. Now, if Bitcoin moves lower, where get some better support? Well, probably right here at around 74, 75K. So let me just go ahead and mark this level. You see how Bitcoin found resistance here was, March of 2024, resistance once, twice, three times, but then the last time it broke. And when that resistance broke, it became support. And when it was tested as support, it held. And notice the confluence also with the 50-week moving average right here. So this level of support was strong. That was back in April. Those were the tariff tantrum lows. So nice bounce. But now it looks like the next test could be coming in the not too distant future here, right around that 74K, 75K level. Now, here's the reason why I don't expect that level to eventually hold. I think it will eventually break. And the reason for that is if I remove that 50-week moving average and instead I throw down a 200-week moving average, Bitcoin tends to test its 200-week moving average during bear markets. And so a test of the 200-week would actually bring BTC closer to like the mid 60s or so. That's seems to be what makes the most sense to me, is that we get some type of a move out of BTC, down to 75, and then that probably holds a support for a time, maybe a little bit of a bounce. It's probably a bounce that you can sell. And then if that level breaks, I would expect there to be, some type of significant long-term support around 65 as we start to get closer to the 200-week moving average. So that's a little bit of technical analysis on BTC. Now, let's go ahead and move on from BTC and let's take a look at, maybe we can move on to Ethereum. I think that's probably the best asset to move on to next. See a similar pattern here. So if we just go ahead and grab a brush, you see this bear flag pattern right here? Pretty clear, right? That is a pretty clear bear flag. And so the support, the important level of support for ETH is this trend line support. Now let's go ahead and zoom in a little bit. Now, one thing to notice is that Ethereum, unlike Bitcoin, Ethereum did not put in a higher high. Ethereum put in a high back here at the middle of December at around, what was that, 3450 or so, 3460. But this recent rally, ETH didn't even get above that recent high. In fact, it turned back around before making a higher high. So it's actually underperforming Bitcoin a little bit. Now, where is the important level of support for Ethereum? Probably right down here at, let's call it 3,000. Now, if 3,000 were to break on the downside, then the first stop for ETH would likely be right here, 2630 or so. But if Bitcoin doesn't hold 75K, then I wouldn't expect ETH to hold 2,600. I do think that that ends up being some support, but it depends on what the S&P does. It depends on what equities do. And so why don't we shift gears and take a look at equities for just a moment. So here's the S&P. This is a daily. Let's just go ahead and zoom in here a little bit, and let's see what we see. The first thing I want to do is I want to remove those drawn objects. Alrighty. Now, the important thing that stands out to me is this gap. This is a pretty big gap. And I mean, look, gaps tend to fill, but this is a big gap on the open on Sunday. So I would expect that if this is going to fill, it fills over the next 2 or 3 sessions, or by the very latest, by the end of the week. Now, if this gap does not fill right here, then we could get into a situation where we've got a gap and go. So a gap and go on the downside, I think, even if the gap fills, it's more likely that we see further downside. And the reason for that is simple. If we just go ahead and zoom out on this daily chart, if we zoom out so that we have a couple years of data, you can see a pretty clear channel that has developed here for the S&P, where we had support. So this is anchored to those COVID 2020 crash lows and connected. The next level here is back in 2022. And then we've got another level of support here in 2023. And then here we've got those tariff lows from back during the tariff tantrum that was in April, the beginning of April of last year. So this is a pretty clear level of trendline support. Now, if you just clone this level and then bring it on up here, you'll notice, hey, this is a pretty well-defined channel. And the S&P is at the very top of the channel. So if the S&P is at the top of the channel, and we should expect this resistance to hold and in fact not be broken, we should expect this resistance up here to hold, then a gap down and go gives us, the potential for a little bit of a correction. So if you marry that with the VIX, so volatility starting to push higher again, we've got vol up here, VIX futures, almost touched a 20 handle. In fact, 1970 got really close to pushing above 20. And so notice we've got this little bit of a double top that has formed. Let me just go ahead and mark that with an arrow here. So we had that top, that local high from, what was that, the beginning of December, right, just below 20, also just below the 200-day moving average. So notice we've got a confluence, this double top. So we've got horizontal resistance, and we've got the 200-day moving average here. Now, if this were to be broken to the upside, a move above 20 would signal that the S&P is experiencing further downside. So if we get a move above 20 in vol, and the S&P gaps down and continues moving to the downside, it could accelerate lower, especially from an all-time high. So I think it's looking to be a little bit more likely that, at least in the immediate term, we see some type of a little bit of a dip out of the S&P. Now, here's how you would know if this dip that I think could be on the horizon is going to be more than just a dip. The way you would know is by tracking bond market volatility. And the easiest way to track bond market vol is simply by using the MOVE index. So this is a measure of bond market volatility here. And the thing that's so interesting about this is its extremely tight negative correlation with the S&P 500. And let me show you that. So the first thing I want to do is invert the price scale. So remember, extremely positive inverse correlation here. So let's just go ahead and add on top of this. All we want to do here is click this plus icon. And what we're going to do is we're going to add the front month S&P futures contract on a new price scale. And what you'll notice is this extremely positive negative correlation here. Inverse correlation, positive, negative, extremely positive inverse correlation. Look at how positively correlated these are. So as bond market volatility has eased from those tariff tantrum highs, the S&P has recovered and pushed much higher in price. So if I go ahead and remove the S&P there and invert that scale back to normal, if we see bond market vol start to push to the upside, and if it gets above 85, well, that would be, a big signal that this correction, if it comes, likely has some legs to it. Maybe not just a multi-week correction. Maybe we get a correction for a couple of months. And so up here, we've got this level of resistance that I can draw in all the way up there at 84. And we've got the confluence with the 200-day moving average. So if the bond market experiences some volatility, then I would expect significant resistance to come in at around 84, 85. So if you start to see volatility spike and the S&P starts to actually correct, then maybe you could buy it when bond market vol gets into the mid 80s. That might be a signal to start buying. So just wanted to point that out. I think that that's actually pretty valuable, as a buying indicator. So we were able to discuss Bitcoin. We took a look at the S&P. We discussed a measure of bond market volatility, the MOVE index. I want to move on from here and start talking a little bit about the yen, because I think that the yen is sitting at a very interesting level, or at least very close to an interesting level, where you could buy dollars and sell yen by getting long USD JPY. So take a look at this here. Now, this is a monthly, and look at this level of resistance. We've got a double top here. So right here, that little high that was back in 1990. So we've got that high from 1990, and we put in a double top. The yen put in a double top in US dollar terms. But what is happening now? Well, what's happening now is we're pushing back up towards that level of resistance. So the more times a level of support or resistance is tested, the more likely it becomes that that level actually breaks. And in the case of the yen, there are some macro items that are going on in Japan and globally that make me think that the yen is likely to weaken further. So this level of resistance here, if broken, I think the yen would send all the way up to 200. So I think, USD JPY at 200, if 162 breaks, I think that makes a lot of sense. And so that would be, a 20% move or so, a 20% depreciation in the yen. So that's definitely something to be on the lookout for. Now, what could we also profit from if we're taking a look at USD JPY? Well, I think that it's important to track rates right now because of how interconnected bond markets are globally, especially the Japanese and United States markets, since they hold so many hundreds of billions of dollars or maybe even trillions of dollars of treasuries. If the Bank of Japan is forced to defend the yen, well, they would have to sell treasuries to raise dollars in order to buy yen. And that would be a way of defending the yen. Let's say that the yen breaks out above 162 and starts rapidly pushing higher. The Bank of Japan would probably have to sell treasuries in order to buy yen to defend the yen. If they do that, how would you know it? Well, you could go ahead and track ZN. That is the 10-year treasury notes here. So this is the futures contract. And if we just zoom in, we're looking at this on a daily. And the interesting thing about notes on a daily is that they've broken down. Notes have broken down below the 200-day moving average. So we had this important trend line support that broke to the downside, retested, failed, and now the 200-day moving average has been broken to the downside. So where is the next level of support in notes? Well, it's got to come in right around right here, this trend line support. But if you zoom out a little bit on notes, and the reason I have this marked is that was the beginning of the rate cut cycle. So if we just zoom out here, and in fact, why don't we just zoom out to a weekly? This pattern is quite bearish. This looks like a relief rally. The last several years of price action looks like just a relief rally after this big move lower in notes, which means big move higher in yields. So this pattern looks like a pause. This triangle, that's more of a pause formation. And so now that if we zoom back in on notes, now that we have taken a look at the longer term trend, which is clearly to the downside, that means that any rally is likely to be an opportunity to get short notes. And that would have been a great trade here, and also here and here. Notice 3 tests of resistance, each time resistance held. Now we've got this level of support down below. If I just go ahead and fix up this trend line a little bit, there we go. So one test, the second test, and it looks like we could be headed in the near term for a third test of support. So you should always expect a level of support or resistance to hold and not break. So it looks like rates could have some legs to the upside. Remember, notes are inverse. The price here is inverse to the yield. So if we take a look at yields on the 10-year right here, we can see that they are starting to break out. And this is a weekly. So I just went ahead and marked that horizontal. Let me remove that. So this level of resistance broke to the upside. We got some continuation. And if I zoom in here to a daily, let's just see what we see here. Where is the next level of resistance? Well, maybe right here, 4.31%, maybe a little bit higher, something like 4.48 up there. That seems to make sense. And in fact, why don't we go ahead and remove this trend line now that that is no longer valid? Let's remove this vertical also. And why don't I draw in some trend line resistance up above? How about that? That looks pretty good. Trend line resistance. And why don't we also draw in some trend line support? Maybe something like so. We've got some trend line support below, and we've got trend line resistance above. Now, here is the 200-day moving average, which was just broken to the upside over the last 48 hours. So we're within this, this little wedge pattern, I guess you could call it. And if I just go ahead and remove that horizontal, it looks like there's plenty of room for yields to push quite a bit higher here. So we could see this move in yields accelerate. And it looks like the next real significant level of resistance in yields could come in at 4.6%. So if I just go ahead and mark that with a horizontal again, right there, it looks like we could be headed all the way up to 4.6%. So if the 10-year is going to push higher, that probably will put pressure on equities. So think the S&P, the NASDAQ, the Russell, the Dow, and maybe also on global equities. So if yields continue to push higher, what could that mean for the dollar? Well, let's go ahead and take a look at DXY. Okie dokie. So if we start on the dollar by zooming out to a weekly, I think that's probably a good place to start, because that way we can take a look at this long-term trend line support. You see that? Long-term support. This dates back all the way to 2011. So we had some support here again in 2021, and over the last year or so, we've been testing support. This is long-term and significant support. Now, the dollar is trading well below its 200-week moving average, but it's right at long-term support. So if yields push higher, that would likely be bullish for the dollar. But in the event that higher yields is not actually bullish for the dollar, then a break of support would likely send the dollar moving sharply lower, all the way down here to 89 or so. That's the next level of support. That's almost 9% to the downside in the dollar. Now, if the dollar holds support, then the next significant level of resistance on the upside, and since we've already broken above the 200-day moving average here on DXY, and it looks like the dollar is coming back down to test support, well, the next level of resistance would be this high right around 100, 100.5, something like that. But if that were to break, then you're kind of in no man's land up here. So really, the next level of resistance, if this local high breaks to the upside, would come in right around 104. So that would be a pretty big move out of the dollar over the next couple of months. And look, if I had to bet one way or the other, Since so many traders are bearish on the dollar, it would make sense to me that the dollar actually rallies. And it's sitting at support. There's a lot of short open interest. A lot of people are bearish on the dollar. And yet we're starting to see yields really push back up. And so if yields are pushing higher, then I would expect the dollar to rally. Now, let's go ahead and look for another piece of information to help booster this thesis of the US dollar rallying as rates rally. Let's take a look at the US 30-year yields here. And this is a daily. And let's see here. What do we see? Well, number one, there's this level of what was resistance. So this is yield. This is the yield on the 30-year bond. So US 30-year yields here. Now, this level of resistance, notice 1, 2, 3 tests of resistance, and then yields started to break out. And we had this important level of support, the 200-day moving average, and there happens to be a confluence there between this trend line support and the moving average support. And yields tested that level of important support and bounced. And yields are pushing quite a bit higher. So as we see yields at the long end push higher, where would we expect yields to really accelerate to the upside? Well, on a break above right here, 4.90%. If 30-year yields get above 4.90%, we should expect them to go at least to 5%. So I'm going to go ahead and mark that level, 5%, on the chart. And it looks to me like that's probably the most likely outcome, that we start to see yields push a little bit higher, on the 30-year, up to 5%, as you see the same thing happen in the 10-year, up towards, all the way up here at 4.6%. And so the speed of the moves here, if we see the 10-year yields move higher, faster than 30-year yields, that's referred to as a bear steepening. So looks like, that's flattening, bear flattening. Yep, so that's referred to as bear flattening. So it looks like that's what we could be in for, higher yields, and potentially, if the dollar rallies on the back of those higher yields, higher US dollar. What does that mean for digital assets if the dollar rallies? Well, it likely means digital assets continue to sell off and actually accelerate to the downside, because that's one inverse correlation that still counts for crypto, is that inverse correlation with DXY. As the dollar rallies, you tend to see crypto sell off. So why don't we go ahead and take a look at gold and silver to wrap things up. So here's gold, just a simple old chart, daily chart of gold. This is a really nice looking parabola that's forming here. And I've marked 5,000 on the chart here. It looks like 5,000 is a nice magnet for gold this year, at the very least. Just big, round, psychologically important number there. But let's do one thing. Let's price this in USM2. That's just to take into account inflation. And I want to go ahead and zoom out to a weekly. Now, this is really interesting. Take a look at this pattern that has formed. So this is the high in gold from all the way back in 2011. Now, gold has broken out above that inflation-adjusted high from back in 2011. But let's get even more data. Let's zoom out to a monthly. And so when we zoom out to a monthly, what we see is, well, gold is really entering price discovery, kind of, sort of, right now. Now that gold has broken out above those 2011 highs, it looks like there is plenty more room to the upside. The next real level of resistance comes in another 35% higher. And if that were to break, then we're talking about all the way up here. And if I just go ahead and grab my measurer tool, that would mean, $10,000 gold is not out of the question whatsoever. And in 1980, that's exactly what happened. That squeeze higher pushed gold, that inflation adjusted to an inflation adjusted record. So it looks like we could see gold push higher by another 35% or so at a bare minimum. let's take a look at silver, and that will wrap things up for the first call. This is the first DeFiU technical analysis live stream call. I'm going to be doing this every single day during the week. And here's silver on a monthly, but I want to do that same thing. I want to go ahead and price silver in USM2 so that I can take into account the rate of inflation. First thing that jumps out here, if I just go ahead and grab this measurement tool and go ahead and delete that, the first thing that jumps out to me is, unlike gold, silver has not touched nor has it exceeded its 2011 high, inflation adjusted high. And so that tells me that silver likely has, another 35% also at a bare minimum to go to the upside. Now, what happens if silver breaks above its 2011 inflation adjusted highs? Well, then it could move all the way up here to this level not seen, inflation adjusted level not seen since 1983. That's another 78% to the upside. And if that were to break, then silver could really start to put in some multiples. I mean, I'm talking about $300 or $400 silver. And it might sound kind of crazy, but there is a precedent. Look at what happened in 1980. So that was my first technical analysis live call, everyone. I really hope that you got something out of that. I hope that it was valuable for you. Please comment, leave me all sorts of comments. I will do my best to respond to them. And I will see everyone tomorrow. I'm going to go ahead and publish this calendar on my school channel, so everyone will be able to take a look at it there. It's school.com/DeFiUniversity. Thanks so much, everyone, and I will see you guys tomorrow.